Welcome back to another exciting episode of 60 Plus Uncensored. I'm your host, Seb Fry, and today's guest is David Nassif, author, speaker, and creator of the One Page Wealth Compass, a simple tool that took him from nearly broke at age 63 to safely a millionaire by age 69. You know, after 18 years with the same company, David heard the words effective immediately and walked out with a cardboard box and a 2-year runway before going broke and running out of all his retirement savings. But instead of folding, he built a one-page system that did more for him in 6 years than 4 decades of doing everything right ever had. If you've ever felt like the math just isn't adding up or worried that you started too late to ever catch up, this episode is going to change the way you see what's still possible. So without further ado, let's get right into it. David, thank you so much for joining me here today on 60 Plus Uncensored. I'm very excited to have you. Now, for many of our listeners, David Nassif, it's not yet a household name. So maybe you could start off by sharing a little bit about yourself, like who is David Nassif and what are you all about?
Okay. Well, I thank you, by the way, for having me on, Seb. I'm excited to be here with you guys today. I've been working in the corporate world most of my life, a good part of my life, I guess. I have a wife and son, and I'm originally from Ohio, but living in Phoenix, Arizona now, and love everything. And my life seemed pretty good, actually, until one day, when I was 63, I had just got fired after 18 years with the same company. I tell you, I would not wish that day on anybody. I did the math, and if I drained all of our savings and all of our retirement, we were scheduled to be broke by 65. When other people are sitting back saying, okay, I'm going to enjoy the fruits of my labor here, and we'd be like, I don't know where we'd be. It would not be a pleasant place. But that wasn't even the hard part, Seb. The hardest part was, that was hard, but is driving home thinking, how am I going to tell my wife, Mary? We had been married for 30 years at that point, and she did not deserve the mess I just threw our life into. So anyways, after a couple months of dead-end job searching, my heart was not in it. I did not want to go back to the corporate world, but I had to keep a roof over our head and put food on the table, and so I didn't have the luxury of just doing what I want. But I was sending out resumes, and basically the response was, in so many words, hey, the company that fired you, they did the right thing. You're of no value to us either. They were very polite about it. They didn't say it like that, but that was basically the message. So at this point, I'm thinking, oh my gosh, what am I going to do? So I decided to take a huge risk. And I went to work as an independent sales agent on straight commission. No salary, no safety net, no benefits. The first months were brutal. Cold calls, constant rejections, rookie mistakes. I heard more in 2 months than I think I'd ever heard in any 2-month period of my life, or more no's. But Seb, as I look back and I can reflect back on it now, all that resistance, all that rejection I was getting, I really believe that was helping me build the mental muscles I needed, the resistance I needed to punch through that dark period of my life. After 10 months of grinding, I had an incredible milestone. I was suddenly making more money than my good-paying 6-figure corporate salary. And for a brief moment, I felt like, we made it. But then I realized, we didn't make nothing, because I've been making good money for almost 40 years, and look where it got me, on the verge of financial collapse. I said, I need to learn how to invest. I need to learn how to build wealth. It's not working. I did not have time for a bunch of theories. I decided, and conflicts of interest, so I dug in myself. I read 21 books on financial planning and things. I listened to 13 podcasts faithfully, blogs, newsletters, read them, put the ideas on one piece of paper, kept putting them on. When the paper filled up, I decided I'm not going to make it more than one piece of paper, so I'll take off the worst idea and put a better one on. I kept refining it to a set it and forget it approach. 6 years later, I did what I thought was impossible. From terrified of being broke to a 7-figure portfolio and real financial freedom. I now know that if I can pull that off at 63, anybody can. It is never too late, no matter what your age is, and I truly believe that.
All right, well, that is very exciting, especially very exciting to me. I really want to hear all about this because I would like a 7-figure portfolio. I have one. It's in the low 2s. Low 6s, sorry. Yeah. So, okay. So a couple questions. What was your corporate job that you did for so long?
Oh, I was actually on training corporate people, sales, marketing, and management people, that kind of thing. And kind of training is basically what it was, yeah.
Oh, you're a corporate trainer. Okay, all right. And then I have to ask, you went into sales. I'm in sales. What were you selling?
That's the boring part. I don't know how much you want me to give, but it was a B2B, it is a B2B, very specialized insurance type product that for businesses to resell. So I'm kind of like the middleman or the wholesaler or whatever you
All
call it.
right. Well, yeah. Well, okay. That's real sales right there for sure. And that's a hard job selling insurance. I know, right? Because
Yeah.
everyone
Oh
sells
yeah.
insurance, right? You know. So
Yeah.
okay. All right. Also, you mentioned 21 books on finance. I've read a few books on finance. Sounds like you're a guy to talk to about that. Okay. Let's just say that you're 63 and now you're whatever out of a job for whatever reason, and you're looking to do some investing or whatever. What are of those 21 books? What are the best three for people over 60 to read today?
That is a hard answer. Let me tell you why. I'm not because each one of them had a different little gold nugget that I really liked. Okay, and that's why I wrote my own book because it says I need to have a place to put all the best stuff here. Because each one had a really neat thing. If you want specific names like John Bogle, the founder of Vanguard, he is an excellent one. No conflict of interest here. He's telling it like it is, and he absolutely shook Wall Street up really big with his pioneer program of low cost index funds, and so things like that. But different books had different things, and there wasn't any one book or top two or three. It was a lot of gold nuggets that I needed to just break all in and keep them and put them on one piece of paper so I could stay focused.
So you're panning for gold in these 21
Yeah.
books, and you found that gold. And
Yes.
well, that's great. So you can save me some time. I won't read those
Yeah.
21 books. I guess I'll
No.
just read your book, which I guess we're going to find out more about that a little later on. But
Sure.
then, but then, David, you said podcasts, and like my ears perked up. So I have a podcast. We're on it right now. What is the best podcast? Are there some good podcasts out there for people who are like, in their 60s, 70s, 80s who want to do some investing, or they all have nuggets of gold?
Again, what I would recommend, because what's going to appeal to me might appeal a little different to some of your listeners. I would just go on Apple and just search, financial podcast or whatever, financial, personal finance, or maybe it's retirement you're looking at, or maybe it's investing you're looking at. And I looked at them all. I didn't just pick one category, But I guess it's whatever your thing is, whatever your weak link is, that's what I would recommend looking at those podcasts, because some of the podcasts I no longer listen to those, but I've got new ones, so they do rotate after a while, because it just depends on what my current interest is and that kind of thing.
Well, all my links are weak. Except for, I guess I do okay income-wise, but it's just like the money flows through my fingers like water, which I think it's not so much as an income problem necessarily as a spending problem, but like where do you cut? I wouldn't want to cut my 5 streaming services. That seems like rash, but
No.
anyway.
You gotta have 5 at least.
You got to have 5. I might have 6 or 7 to be honest. I don't really know, but okay. Now I have to ask, how did you do it? How did you do it, David? You went from 63, and in
Yeah.
7 years you built a 7-figure portfolio. What's the story? How did you do it?
Well, let me tell you what happened that really turned my whole life around in that dark moment, okay, that dark period I was going through. The same time I was going through all that, I heard a true story, and I'd like to share it because it just gave me a 180-degree turnaround on everything. And what it is scientists at the Max Planck Institute did an experiment. What they did is they placed people in the center of a dense German forest, and they told them to walk in a straight line to the edge. Now, these were confident and capable people, but when the clouds covered the sun and they lost their point of reference, the GPS tracking they were wearing showed they were gradually starting to walk on circular motions. Some of them were actually ending up right back where they began. Yet every one of them was absolutely convinced they were walking in a perfectly straight line. Seb, that is me for 40 years. I was making good money, doing what I thought was working hard, investing in the way I thought was good, and I was literally going in circles. At 63, I was literally on the verge of a financial cliff. And I said to myself, no more, I need a compass, but not a metal compass like the travelers use. I need a one-page compass, because I'm the kind of person, I don't know what you're like, but I'm my kind of person, I get distracted real easy. Shiny object, hot tip, I'm going off to the races in the wrong direction, okay? I couldn't afford to do that anymore. I was 63, my runway was short. It was more like a helicopter pad than a runway. I didn't have the time to make all those mistakes like I did for 40 years. So that's when I says, okay, I need it on one piece of paper, give me the 30,000-foot view so I could stay focused and go in the right direction. And that's the start of what changed everything for me. And that's when I started reading the books and putting the things on the paper and that kind of thing.
Okay, well, I know you have a lot of very important nuances to share with us. So let me again, I think 63 is a good age. That might be the average age of a listener to this show. I don't have no idea, but let's just say that it is 63. So many 63-year-olds, the vast majority, I think, probably 3 out of 4, hit 63 with no appreciable retirement savings at all, and a lot of them aren't really going to be having high incomes anymore at 63, right? They might be a Walmart greeter. I don't know what they're going to do, right? So let's just, I mean, maybe not. Maybe you have some other gig going, but you probably, I mean, a lot of them. I mean, what's the average income in America? I don't know. Is it $75,000 a year? Is the average income, right?
For
So
household, yeah.
for a household, right? Okay,
Yes.
so let's just say you yourself are making 50,000. Is it possible if you yourself and you're retired and it's you and you're not supporting your kids, it's you and your partner are in a small house or whatever. You don't have a huge mortgage payment. You have
Yeah.
minimal debt. Ha ha.
Yeah. Right.
Just kidding. So, what do you do? Is it possible
Yeah.
for somebody in
Yes.
that circumstance to really get to seven figures from essentially zero in 7 years? And how? How did we do it?
Okay,
What's the secret?
okay. First of all, I'm going to tell you how, but I want to back up just for 1 second to address something. I am not saying, and I would never say, that someone can go from zero to seven figures in 6 years like I did. Yeah, there are some people who might be able to, your listeners, but some people aren't going to be able to. That's not my point. My point is you will improve significantly over that period of time, okay? And for some people, maybe it's going to be seven people. For some people, it's going to be less than that. And some people, it's going to be more than that. So I just want to, I don't, this is not a, everyone's going to get rich overnight, that kind of thing. This is not what I do at all. But let me
Well,
just share
thanks for
with
being
you.
on the podcast, David. We'll have you back.
We thought that was what it's about. You could have told me that in the pre-interview, could you? Okay, no, let me just say this. So, I want to dispel the lie that people are maybe thinking right now. Oh, if I made as much money as David, or if I made as much money as Seb, yeah, I could invest too, but I'm living paycheck to paycheck, buddy. This is not real for me. I can't do this. Okay, let me tell you why that's a lie. The NBA, the National Basketball Association, the average player makes over $10 million a year. I didn't say $10 million in their career. I said in a single year, average. Okay, and yet after 5 years of retirement, 60% of them are broke, according to the Netflix documentary Broke. The NFL is even worse. After only 2 years of retirement, 78% of them are either bankrupt or in serious financial stress. That's according to Sports Illustrated. Now let's compare that to Dale Schroeder, a basketball-loving carpenter who made average to below average income his entire career, and yet he chose to live on less than he earned and invest the difference wisely. He ended up with a $3 million portfolio. So that's more money than most of the NBA and the NFL players making their $10 millions a year ended up with their retirement. So my point is this. When I made the compass, I realized something like a light bulb moment. Making money is different than building wealth. I was pretty good for 40 years at making money. Those NBA players are unbelievably good at making money, and yet they and I were very poor at building wealth. But Dale Schroeder, he wasn't very good at making money, let's be honest with you, okay? But he was a master at building wealth. And that's what I'm talking about here. Some tweaks in your lifestyle and tweaks in your things. And no, I'm not talking about living like a monk here. I didn't live like a monk, and I'm not saying anybody should live like a monk. But there are some tweaks you can make that are fairly painless, to be honest with you, that can make a huge difference. And that's what I found out in doing my research and applying it for my situation.
So, is it really more about just like cutting these expenses, like my 18 streaming platforms and my, Whole Foods lunch, which costs like $30 a day? I mean, just for lunch at Whole Foods. I mean, like, is it really about cutting spending more and then putting that stuff like, okay, I don't go to Whole Foods and instead I get a can of tuna and a head of cabbage and I eat that for lunch? I mean, like, what do you have to do? I mean, like, is it more the spending discipline or is it the investing discipline or like what's somebody to do?
Well, first of all, don't cut out the Whole Foods lunch. I love those lunches. That buffet thing you go through. It's a wonderful thing. So I wouldn't do that for sure. But no, I heard someone say this once. It's a financial guru. And she said the following. In terms of, you can have whatever you want, just can't have everything you want. Okay? And so no one's saying, okay, take all your favorite stuff away. But maybe instead of the 8 streaming services, you have like 4 streaming services. But we're not talking about, but let me tell you that where the real money can be made, and it's painless. I mean, it is zero pain. You can go, keep going to Whole Foods and keep doing the streaming services, and you just do this, and you're talking big. Let me explain how I did it for 6 years, give your listeners some actual concrete specifics. I doubled my portfolio 3 times in a 6-year period. Now, I know people in the finance world will say, that's not possible, Dave. The market didn't go up that much. You couldn't have done that. You're either lying or delusional. I'm neither, okay? First of all, let me tell you, I wasn't day trading, trying to time the market, or chasing crypto. I was doing the exact opposite. I was doing something so boring it would put you to sleep. My approach was very different. And what happens is when the market was down, Seb, I was thrilled. When other people were panicking and selling, I was buying more shares at discount prices. My only regret is the market wasn't down more during that 6-year period because I'd even done better than I did. But the thing that really surprised me was the math. There's a thing called the rule of 72 in finance. So what it says is if you're making a 10% return on your money, say, your money will double every 7.2 years or roughly every 86 months. My first double when I created my compass and started following it, it occurred in just 30 months. The second double, 13 months. The third double, 29 months, for an average of 24 months, way less than half the expected 86-month time period. But the secret wasn't the returns. I was doing 3 things I didn't do for 40 years. I never figured it out. Number 1, I was saving a good portion of my income off the top. Before I started doing anything else, that came off the top, just like taxes come off the top. Well, this is the other thing, okay? The second thing I was doing, I was taking that money and putting it in the right kind of investments. And what I found in my research is low-cost index funds is the absolute best way the average person can really build wealth. And let me tell you, my program is so simple. My approach, is so simple. I only invest in 2 funds. 2 funds is all I have. One is the total U.S. market. I own every publicly traded share in the United States. The other is the international market. I own every publicly traded stock outside the United States. So, Seb, I literally own every publicly traded stock on the planet. For me to go to zero, the entire world economic system would have to collapse to nothing. And if that happens, we have bigger problems than the money, okay? But anyways, that was really important. And the third thing I want to mention I did, which I didn't figure out before, is I was using market volatility to work for me instead of against me. So many people invest with their emotions, and which creates buy high and sell low, which is the opposite of what you want to do, which is what I did for 40 years, by the way, okay? But I ended that cycle because I understood now when things, let me ask you something, Seth. If you went to the department store and they had a sign, 50% off sale, would you go up to the clerk and say, hey, I don't want no 50% off. You tell me when it goes back to full retail. I only buy things at full retail. You wouldn't do that. You'd be a nut. But on the stock market, people do it every day. Oh my gosh, the market's down 50%. I got to get out. No, that's when you want to buy. It's on sale for over 200 years. The market, every time it's went down, it's not only fully recovered, it's gone on to reach new heights. And 200 years of data is good enough for me. I'm very comfortable with it. What I learned is how to build wealth twice as fast with half the risk compared to how so many people are doing it. And that's the deal.
Okay, well, so I got so many questions now. So, okay, you say take money off the top, and so that sounds to me like dollar cost averaging. So if you're going to be dollar cost averaging, how do you have money around to buy the dip? Because then, I mean, if you only own 2 funds, that means you're dipping along with everybody else. So what's the strategy there?
Thank you. That is an excellent question. I appreciate that. Okay, here's the deal. I don't time the market. Okay, what you're saying is buy the dip. I don't buy the dip. Buy the high. I don't buy the high. I pay myself once a month, okay? And when that hits my checking account, I take a portion of that and transfer it to my investment account. A portion goes to the U.S., a portion goes to domestic. I click out, I'm done. 5 minutes a month is what it takes me to invest. I don't need an advisor for that, okay? 5 minutes a month. But my point is this, when the market is down, and it happens when I'm buying, then I got lucky, okay? If the market's up, I still buy. I don't vary my timing on my market buying. Whenever I pay myself, that's when I invest, which is once a month for me, okay? And that's exactly what I do. And I don't care if the market's up, down, because you know what? Over a 6-year period or beyond, it's going to continue to go up and up and up and up and up, and you're just going to buy when you buy, but don't vary that. Buy. Don't say, oh, the market's a little high. I'm going to wait a couple of days, maybe it'll go down. No, I tried that a couple of times and I got bit by it because it didn't come down. It went back up and it went higher. And I ended up spending more money on the stuff that if I just bought it. So thank you for that question. Never market time. That is a loser's game. It really is. And I played it for 40 years, so I know what I'm talking about.
So never buy on the dip. So just dollar cost averaging. Just buy a certain amount every month,
Yep.
And that's just it. That's the deal.
And you're going to get some down months, and you're going to get some up months, and just go with it. Go with the flow. I promise you, it's going to all flow up in the right direction. It really does. For 200 years, it's done that.
Right. So you would advise that, I mean, you're doing this, so you must advise that these low cost index funds, right? So maybe people don't know what is a low cost index fund.
Yeah, let me give you an example of what it does to buy those low cost index funds. Basically, what they're buying the entire market. So you don't need an expensive advisor to manipulate things and buy and sell, which increases your taxes, by the way, increases your fees, by the way. It's just buying the whole index, buying the whole fund, the whole market, I should say, okay, that is a very low cost way to do it because they don't have to hire a bunch of people. It's just you buy the whole market and just hope that, and just, that's what you do. But let me show with you the power of this, okay? Because this is the biggest financial mistake I believe most people make in the world of investing. And the tiny fees are like termites, okay? You don't notice them until your financial world starts to crumble on you. And let me explain exactly what I mean by that. Okay, two people, both, let's just say they're starting out in life 25 years old. They're both decided to work for 40 years, probably till they're 65 or whatever, and they both decide to put a modest $25 a week away for investing, okay? Person A puts them in a low-cost index fund with a 0.03% annual management fee. You can't get cheaper than that, okay? Person B goes to an advisor who charges a full 1%, which is typical, and they put him in an actively managed fund with an upfront load of 5.75 and an ongoing management fee of 0.66, okay, which is very common, okay? Now, let's fast forward 40 years to 65, okay? Exact same contributions, exact same market returns, market situation, okay? Person A has a $1 million portfolio with a modest $25 a week. Person B has a $570,000 portfolio. Same market returns, same exact investments. The only difference was the fees eating away like little termites at the portfolio. And that's a $430,000 difference. Well, yeah, $430,000. That's a lot of money. $430,000. That's more than some people retire with. Okay, and that's just the difference. And we assume they never got a raise. If we factored in a raise, Seb, that difference of 430 would even be bigger. But here's the real tragedy of it all. Person B probably feels like, oh, I got great service. I like my advisor. He knows my kids' names. We went golfing a couple times. Little did he realize he did the equivalent of funding someone else's retirement with half of his own money. And that is wrong. I am not against advisors, but what I am against is products that enrich Wall Street at the expense of their clients' portfolios. And I'll be the first to admit here, Seb, and it's embarrassing to admit this. For 40 years, I never questioned fees. I just thought those are the rules of the game. That's how you play the game, okay? Once I got my compass, I realized, okay, the rules we don't question can cost us the most. In person B's case, it cost him $430,000. That's a lot more than cutting back on some streaming fees or cutting back on your dinners at Whole Foods, okay? We're talking serious money here, serious money.
That is serious money. Okay, well, so many more questions again. So, okay, I know some financial advisors. They seem like they know what they're doing. Is it not possible to get an advisor that will actually be worth the weight and the cost?
Well, let me tell you. Here's my opinion on the whole thing. I don't have an advisor, and I have had them in the past, okay, when my 40-year journey, but I don't have advisors now. And here's why I don't need them. Because I have my compass and I have a clear understanding of what's going on. What the deal is Wall Street loves complexity. Here's the truth. Simplicity is for winners. Complexity is for victims. Okay, and I believe that there's an incentive for Wall Street to try to make it sound so complicated that you need them and they need their 1%. That 1% can cost you a fortune. But here's the people who need advisors, Seb, because I'm not saying they're not worth something. They are. People who, one, don't want to get the knowledge, and two, they are very emotional people and they just can't control it. When the market's down, they don't understand and they just panic and they want to sell everything and that kind of thing. That person needs an advisor and he better get one so we can talk him off the ledge when the market gets volatile, okay? But my point is, if you understand and use market volatility to your advantage, it's actually pretty exciting when the market goes down, in my opinion, and that's when I make some really good money. But I don't time the market. I just happen when it happens. So now I'm not against advisors, but I don't think most people need them unless emotionally you need them or you need them because you just don't want to learn a single thing. But the scary thing about that is when you put your whole financial future in somebody else's hands that isn't you, do you think they care about your future as much as you do? There's nobody that cares more about your wealth than you do. And that's why it's scary for me to put if you want to get advice, you still should know what's going on. You still should understand it. You never blindly give it to them. That's my opinion, anyways.
Right. Okay. Well, certainly they care about their own wealth more than they care about your wealth. I think that's probably a given, right? I mean, I
Yeah.
know they have a fiduciary responsibility, but at the end of the
Oh,
day, who's
don't
number
get
one?
me, don't get me going on fiduciary. You know what else has fiduciary responsibility, Seb? Attorneys. Now, we all know all attorneys are honest, right? They never would do anything that would be dishonest. Well, some attorneys are not so honest. I'm telling you, I could tell you stories about fiduciaries that just shocking. When I see fiduciaries, it means nothing to me. I mean, I'm not against a fiduciary. I'm certainly not against them. But they're not giving me any more comfort by saying they're fiduciary, because I've been attempted to be ripped off by fiduciary, and it was a pretty big, serious thing, too.
Right. Yeah. Well, I mean, people are people, right? So
Yeah, that's
there's
right.
good people and bad
Yeah.
people. I'm
In
sure
every
good
profession.
fiduciaries and
There
bad
are. There are.
fiduciaries.
I totally agree with that. I totally agree with that.
So you're mentioning these Vanguard low-cost index funds, but I've always heard you should just get an S&P index fund. So
That-
I didn't hear you talking about S&P
No,
index fund.
no.
Everyone says S&P gold standard. Almost
Yeah.
impossible to beat the S&P.
Yeah, no. Let me clarify, because I'm not. I'm an index fund is you're buying the whole index. The index could be the S&P 500. The index could be the entire market, all of the ones. The index could be like just the an index for just the tech industry. So an index is like you're buying the whole segment of a market or the entire market. And S&P 500, that's buying the top gold standard 500, top business out there. So corporations. So I'm not against it. I mean, I would feel very comfortable. Mine isn't the S&P. Mine is the total U.S. market, but I'd be comfortable with it totally. And the returns are almost identical when you do a comparison. The S&P and the total U.S. market, they're almost, because it's weighted average. So in other words, a big company is going to have a lot more. You're going to have a lot more of them than the little tiny companies. So it's really almost everyone has an S&P in some respects, in a way. If you have the total
Okay,
market.
so it's good. It's good to do the S&P 500 because
Absolutely.
I'm an idiot. I'll be first to admit it. I'm an idiot. I buy stocks and I go up and down and I sell low and buy high, right? I mean, like, I'm a total moron. And like, I got a friend who works at Edward Jones, right? And he's like,
Okay.
oh no, dude, just S&P 500, just like end of
That's
the
right.
day, right?
He's a smart guy.
He's a smart guy. So stock picking, I mean, like that's one thing I do because I'm like, oh, this is gonna go. I mean, sometimes like I have made some good stock picks, and I have made tens of thousands of dollars off of some stocks, over a relatively short period of time, and then I've lost tens of thousands of dollars on other stocks.
That's the other piece.
So do you think that nobody should be buying stocks? Like the average 63-year-old person watching this or listening to this podcast today?
For the average person, I would say stay away from individual stocks. Now, if you want to make this your profession or you want to make this your intensely serious hobby where you spend hours and hours of studying the market, that's another deal. I still wouldn't do it, but I mean, that's fine. That's up to the person. But for the average person that doesn't want to spend, I told you, 5 minutes a month. If I spend 5 minutes a month buying individual stocks, I'd be broke in no time, okay? So it depends on who you are and what you want to do. Here's what I say. If you love doing the stock picking, take a small percent, like 5 or 10% of your portfolio, and play with it if you want, but not the majority of it. Let the majority of it, set it and forget it. Let it work. Let it build. I discovered that doing nothing beats every financial strategy I did for 40 years. Doing nothing has made me wealthy. All the other stuff was not making me wealthy. And what I mean by doing wealthy is just what 5 minutes a month is transferring to. That's basically nothing compared to what I used to do.
Right. Okay. So, I'm taking some notes here. Now there are other types of investments that are touted these days, specifically like crypto, right? So like there's crypto bros all over the place. New crypto funds are forming every day, and a lot of people have made a lot of money in crypto. So is crypto a scam? Is it a good idea to invest in crypto? What are your thoughts there?
Yeah, I don't think it's a scam. Okay, I think it's a real thing, and people have made really good money off crypto, and people have lost really good money on crypto too. To me, it's just too. I don't want to study it. I don't want to research it. It's not diversified enough for me at all. When I own every stock on the planet, you can't get more diversified than that. I sleep so good at night. But if you own crypto and the next day crypto crashed, what kind of retirement is that? You're stressed about, the crypto market and all that kind of thing, I don't stress about nothing because with my diversification. So again, that's part of the thing where I'd say, if you want to carve out 5%, where if you lost it all, it wouldn't really hurt you. I'd say, hey, if it's fun for you to do, that's fun. I definitely wouldn't do any significant percentage of your portfolio in that, though. Again, that's just my opinion.
Okay, all right. Well, yeah. So, I mean, I know people have put in a small amount of money in 10 years ago, and now it's a gigantic amount of money.
That's
So
it.
I'm like, oh, because I'm like, crypto's a scam. This is dumb, right? But I'm
Well,
poor, and they're now rich or
Well,
whatever.
yeah,
So,
but I promise you, Seb, for every story like that, there's 100 stories of people who lost money in the crypto, but they don't brag about it like the people who made the money.
right,
They don't talk about it. It's like quiet. There's nothing to talk about. So you get the raw false sense of, oh, everyone's making money in crypto, and not really.
right. They keep it quiet. Okay.
Yeah.
So now I'm a realtor in my line of business. People oftentimes come into large sums of money, particularly people who have a spouse has died or they inherited a property and they have a liquidity event and they're going to get 500,000, a million, 2 million maybe. And then the question is, where do I put like a big chunk of money just like
Perfect.
that? Because not dollar cost averaging, man. This is like one shot
Yeah.
coming in. So sometimes people say, well, you should get an annuity, for example, right? Or you should get T-bills or CDs or
Yeah.
what do you do if you have like a liquidity event like that? What should you do with all that cash?
Well, let me show you what you should do with it, in my opinion. And I'm going to give this to all your listeners for free, so I'm not pitching anything here. Okay, it's free. I would take out the one-page wealth compass, which I designed. Okay, and on the one side, it's the 5 trail markers to financial freedom, and it takes you from starting with earning money, which is the first step, all the way down to financial freedom and everything in between. And I'd find out where you are. Now, for example, if you're in a situation where you are in debt, you're in credit card debt and you're in other kind of debts that's, student loan debt or whatever, the first thing I would take off the top of that money and I'd get my debt down to zero. Okay, I would get rid of that debt. Now, I'm not talking mortgage debt. That's a different deal. Okay, and the mortgage is fine because it's appreciating asset. But things like a car or your student loans or your credit cards, that's not appreciating. I mean, yeah, an education will appreciate for you, but that money isn't appreciating. It's actually costing you because they keep charging interest. So I'd get out of debt first because that money, now what you've done is you've turned the tables. Instead of paying interest to get somebody else rich, you stop that program so you can turn it and make it yourself rich by investing it. Then I just go down to the deal. Wealth accumulation, smart protection fund. You want to make sure you have a protection fund and do that. And yes, I would put a portion, depending on your age and where you're at in retirement. Again, I talk about this in my book. I'm going to put some in T-bills maybe, okay? I'm going to put some in fixed income. But if I'm younger, I'm not doing that. I'm putting 100% into the equities because this is your time to grow. And this is your time to pray for market volatility, pray for the market to go down so you can ride the wave back up with a thing. But if I'm like getting to retirement age, no, I'm taking a percent of that and putting it in fixed income, like you're talking about treasuries, things like that, to protect me. So, because if the market goes down, I don't want to withdraw money if I'm living off my portfolio when the market's down. I want to withdraw the money from my fixed income, which hasn't dropped because it's like a treasury bill that's going to be fixed, short term especially. So I don't know if that answers your question, but that's how I would do it.
Right. So like an annuity, I mean, like annuity, is that a good thing? I mean, you hear about annuities all the time. I mean, they're
Yeah.
safe, right? They say.
Yeah. Well, they say they're as safe as the insurance company that's offering them. And there's different kinds of annuities, and you got to be very careful. If a broker is offering it to you, there's going to be a load. There's going to be a commission in there for him, and it could be pretty sizable because they're very lucrative. But you can go online, very safe places online to go and find annuities that you buy directly from the insurance company. There's no middleman, and you can compare the fees, and it's much more lucrative. I prefer keeping my money in the market because annuities, they're not going to appreciate anywhere like the market is. And for the guaranteed piece, which that's peace of mind, you want to sleep at night, I would go the fixed income route. But I'm not saying if you're more of a senior person, you want annuities for that guaranteed check every month or whatever it is, hey, I'm not going to be against that. But just don't overpay for it. That's the thing. Just because your cousin is offering it to you and he got into the annuity business last month, check that out because that could cost you a lot of money.
Right. Okay. Good to know. All right. So, but now I have heard that the PE ratios, they're very high right now. They say, right? I mean, like are they the highest they've ever been? Right? What are they, 25 or something like ridiculous like that? Right? That's the kind of level where there is usually like a significant correction in the market. Are those two things correct?
Yeah, I try not to even think about that. Let me tell you why. Okay, here's why. Because it's not necessary. Here's why I say it's not necessary. When you have over 200-year history of the market, anytime it goes down, it always recovers and it goes on to new heights. And that's just fact. That's like historical fact. That it's going to keep going up. Okay, yeah, there's going to be dips, and the PE ratio is going to make adjustments on people. But I don't get involved in that piece of it because it had nothing to do with making my money. I made that money, and I didn't study one ratio of anything. I just bought these two funds and let them ride, and I kept adding to them every month. I added them to every month. And so sometimes we can get so much. That's where the complexity comes in. That's where you think, oh, geez, yeah, I don't know about P ratios. I better get a financial advisor so he can explain that stuff to me and make sure I've just buy the whole index and don't worry about it. It's going to go up. It's going to keep. Now you're going to get dips. And you got to be comfortable with that. But you're going to it'll recover and go on to new heights. Historically, it always does.
Well, like older people, right? I mean, like they're worried that there could be a protracted dip, right? Just at the time where they need it most. And as you say, you don't want to be spending your seed corn, at a time when the market is appreciating, which is why it seems like it might be good to have a diversified portfolio, like T-bills, CDs, an annuity, maybe. I mean, but you don't have any of that. You're all in on the stock market. Is that right?
But I'm not the common person. I'm not the average person. Let me talk about that. I don't mean that in any way but here's what I mean. I don't live off of my portfolio. I make a very good income with my company. Last year was our record year for us. So I don't need that money. Now, if I was needing that money to live off of, oh, you can bet a good portion of that would be moved over into treasury bills or that kind of thing, so I'm protected, so I can pull that money out. And like you say, if there's a protracted downturn, like for 5 years or whatever, I don't want to have to touch my equities because they're down. That's the last thing you want to do is withdraw money to live off of on your equity if it's down. That's where the fixed income comes in handy, because then you pull it out of that and you're not losing anything. And then when the market recovers, then you can, when the stocks are up, then you can take some of that money and replenish your fixed. Okay, now you never lost anything. You just kept growing with the market. So I'm saying if you're 5 years or 7 years away from retirement, or 3 years depending on your risk tolerance, you need to consider moving some of your money into that secure, safe fix. So when you do get retirement, you can sleep good at night, go on your vacations and enjoy things and not stress about the market.
Right. Well, so, they say, I believe it's true, that, for most Americans, the greatest segment of their wealth is in their real estate. And like here in beautiful California, we have many people who have $1 million in equity, right? And the market in California is not appreciating to any degree. In fact, many parts of the market are depreciating after several years of really strong growth, right? And it's basically dead capital, right? I mean, like you're sitting in a house, it's dead capital. Maybe you're 63 years old, the kids are gone, you're living in a 4-bedroom ranch house, and you really use 1 bedroom and a living room and a kitchen. And the weeds are growing tall in the back in the front yard because you're not out there playing catch or whatever with the kids. So is it a smart idea to use that equity in your house, or just what do you think? Because that's very common. People are house rich and cash poor.
Yeah, that's a tough one because I don't count my house. I believe strongly in buying a home. I truly believe it because you can now lock in your expenses and no one's going to raise your rent, that kind of thing. But I don't consider that part of my portfolio, even though it is. I mean, I get it is, because I can't tap into that. I'm not going to get a reverse mortgage. Oh my gosh, the nightmares I've heard of reverse mortgages. I mean, I'm not saying they're all bad, but I'm just saying be very, 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 very careful with that. The thing I would do, and I know a lot of people my age, I'm 72, okay, a lot of people my age, they don't want to leave that house. They've lived there for like 20, 30 years, they don't want to leave the house. But what I would do, because I don't have any emotional attachment, I would sell that house, downsize into something you can afford, and then take that equity and use it to live off of or whatever you need for it. That's what I would do. So I get to somebody like you, a realtor, and say, okay, sell my house and buy me a less expensive house. That's very nice. I don't mean, I don't mean, when I say downsize, I mean, nice downsize type thing. And that's how I would do it. But that's David Nassif personally. That doesn't mean that all your listeners are going to want to do that. But that's tough when it's all in your equity and is in your home. That's tough.
Well, especially because so many people don't really have any kind of portfolio to speak of, right? They have $1 million in equity in their house, right? And then they don't have any kind of portfolio. And I just wonder, like, is there better places for that money to be aside from trapped in your house? And I guess if you were to sell your house, then you would want to put some in the T-bills. I mean, if you're 63 or 73, a lot of them are 73. A lot of them are older than that, right? They're your age maybe, right? And so I think that a lot of people are stuck in this house, and they're like, they're kind of stuck because they don't really have any cash. They feel that they're broke, but they might have a net worth of $1 million, right? After all is said and done. So Well, okay, that's interesting advice. And then you said one other thing, which is very interesting to me. You said get out of debt first. So if you're in debt, aside from your mortgage, should you not be investing in the stock market? Should you not? I
Yeah.
mean, if you have like a $5,000 credit card balance at the end of the month, and you're like, do I put the $2,000 into the stock market, or do I pay off $2,000 more of my credit card debt?
Yeah, I would say credit card. Here's why. A lot of people, when you talk about, debt arbitrage, is that what it's called? Where, okay, I'm making more money, David, off of my investment than I'm paying on the credit card, so I'm not going to pay that off. Yeah, but what they're not taking into account for is the risk factor. Okay, say the market tanks or say the economy tanks, and that money they were making more now is less, and all of a sudden they're putting themselves in jeopardy, their jobs in jeopardy, and now that debt is a real issue with them, and that's a real threatening situation for them. They could lose their house, they could lose their car, they could lose whatever it is they're in debt with. And so I would say that, yeah, debt is risk. I'm not talking about mortgage debt for a home, but even that, I believe in having a decent equity position in your home. But no, not that other stuff, because that arbitrage is not considering the risk factor, and no one considers it until it's too late. Then you're really in a bind, and so I would definitely get off of consumer debt.
Yeah, debt arbitrage. Huh? I like that. Okay, right. So get out of consumer debt, and then people have like medical debt, right? I mean, like there's all kinds of debt that people might have aside from their mortgage. So all of that you're thinking before you make any kind of investment. That's what your focus should be. Should you liquidate your 401k or IRA or whatever to pay off the debt?
No, don't do that, please. That's the one thing you want. That's growing for you. You want to keep that, and so you don't want to touch that. But before you keep adding to it, let's get out of debt first, and then let me tell you another thing that's interesting that a lot of the gurus, the famous gurus that everyone knows their names, advises. They say, okay, once you get out of debt, the first thing you do is get a 3 to 6 months emergency fund, because then you're protected and you're secure. Then you start investing. Well, when I made my compass, I did the math and I questioned everybody. I didn't care who they were, what their name was, and all that kind of thing. And here's the thing I found out: if you're like, say, you're 25 and you're in debt and all that kind of thing, and you get out of debt, now you freed up your cash flow, and they say, okay, 3 to 6 months emergency fund. Okay, that's going to take the average person at least a year to get 3 to 6 months of their income and an emergency fund. That's going to at least, and maybe a year and a half or two. Okay, so let's just say it's 1 year. Okay, so what happens is you're out of the market for a year that you could have been in the market because you're debt free now. And if you fast forward that for 40 years, okay, to your 65, that costs you $500,000 by just waiting that 1 year to get investment. What I say in my compass is this: when you get out of debt, you just freed up a bunch of cash, okay? So before you increase your lifestyle real quickly, let's do both at the same time. Okay, yes, invest, but build your emergency fund, I call it protection fund, at the same time. Now you're not out of the market for a year, you're getting in the market, you're investing in the market, and you're also building your safety net there, and you're doing them at the exact same time, and now you're not out of $500,000 when you're 65, and $500,000 is a lot of money. For some people, that's their whole retirement money, okay?
So how much should you be like siphoning off the top of your income? I mean, is it a percentage, or is it a number based on your age, or what?
Yeah, it's a percentage for me, anyways. I think it should be a percentage for most people, because then it just makes it easier too.
So pre-tax income, what percentage should you be cutting right off?
Ideally, around the neighborhood of 15%. Now, if you're 12%, I'm not going to say, oh, that's terrible. And if you're 18%, I'm going to say, oh, that's terrible. No, but I'm saying in that neighborhood of 15%. Give or take a few percentages, but that's where you want to be, but not until you're out of consumer debt. Okay, then yes, do that, because that's important. But that protection fund or the emergency fund, that's important too. I don't want to downplay that. You want to be building that at the same time. It may be go a little slower because you're investing at the same time, but you want both, because if you don't protect yourself, there's going to be something happen, and then all of a sudden you're being a boat where you have to sell your 401k because because you don't have an emergency fund. So you want to have both. You really do.
Okay, all right. Well, that sounds smart, very smart. So you have mentioned several times now your compass. Is this that one sheet that you showed us, or what is the compass that you refer to?
Let me just show you how it works. It's real simple. Like I said, everyone's going to get for free at the end of the show. Basically, it's 2 columns, and this is the 9 trail markers. Okay, now I start out with career and income because every book I read on finance seemed like they never talked about like building your income and increasing your income. I guess they assumed, well, if you read my book, you probably have good income. Well, no, that's not true. A lot of people are underemployed, underpaid, underappreciated, and they don't have the good income. So I figured that's the engine that drives so much stuff. Seb, you say you're making good money. Well, you would probably just skip that one then because I am making good money. I don't need that. But not everybody can skip that. So that's the first thing. 3% protection fund, debt freedom, okay? Wealth accumulation, smart protection fund, it just goes down the list here, okay? It's real simple. Now, let's just say the other side, the 5 North Star principles, this keeps you out of trouble. For example, what it is live on less than you earn. Those basketball players, they never learned that first principle, okay? And that's why in 5 years, most of them are broke, okay? And that's because they didn't get this first one. If you don't understand how to live on less than you earn, any book you read, any financial plan you read, it's going to be very difficult. You're not going to be able to make much money because you're draining more than you have. And there's several principles like this. But here's the deal that's kind of neat about this. Seb, say you're on the debt elimination, and you go, okay, David, that's nice. You say debt elimination, freedom strategy, and you have a couple more words here, but I need a little more help than that. Well, that's where the book comes in. And that's what it says here. Go to chapter 4. And you go to chapter 4, and it tells you exactly about how to get out of debt, the different ways of getting out of debt that fit your personality the best, and that kind of thing. And so this is like the 30,000-foot view that keeps you going in the right direction. This is the ground game. Take a right here. Take a left of the light. Take a left of the stop sign, okay? And sometimes you need the more detail, and sometimes you need this. And what I do is I bring them together once a week at 4 o'clock on Fridays at 4 o'clock. I have my calendar. I have my 2-minute wealth checkup meeting, okay? And what I do is I go through my 9 trail markers to find out where I'm at and where I'm going, what I'm working on next to get and then I look at my North Star principles and see, hey, did I do anything that got me into trouble or that kind of thing? I remember I read once, I made an impulse purchase one week, okay? And when I had my 2-minute meeting with myself, I realized I didn't wait the 24 hours that they recommend it before you do it. And that cost me money. But you know what? Except I caught it that week. And so I didn't do it again next week and the next week. And then 6 years later, I spent $100,000 on impulses because I didn't, and have you ever read a book before? Great idea in the book. That's going to change my life. 2 years later, you come across an idea and you go, oh yeah, I forgot about that. Well, that doesn't happen when you're having a 2-minute meeting because if you're still on the debt freedom thing and every week you're not doing nothing, after a while you say, listen, I got to start doing something because I'm going to do anything. And this is kind of like the behavior modification to make this thing work for you, okay? And that's kind of when you bring them together, it's kind of like you got the laser focus, 30,000 foot and the ground game, and they all work together beautifully to get you where you want to go.
So that book, is that on Amazon? Where can one get that book?
Yeah, the book is on Amazon. It's called One Page Wealth Compass. It's very inexpensive. It's a paperback, okay? This is free, which I encourage everyone to go to, just so they know, onepagewealthcompass.com/free. And you can download this, look at this, take a look at this, sit down and look at it. And if you say, this makes a lot of sense, then get the book. It's very inexpensive on Amazon. The two of them together, I'm not selling anything else. You can't buy anything on my site. Everything is free. I have a blog, that kind of thing. I'm doing this for a passion project. When I was in the dark place, Seb, and a scary place, and I got the inspiration for this compass, when I got out, I says, it's the ultimate in selfishness not to share this with people. So I'm doing this because I want to give back. I want people to understand you don't have to be where I was at 62. You can stop this and turn things around fairly quickly, too. Fairly quickly.
So is that book available on audiobook by any chance, or is that a book I have to...
Yeah, no, it's coming out on audiobook. Matter of fact, I just auditioned the audio readers, and I got one. So it'll probably be out within a month on audio. Right now, it's a paperback and an ebook. You get ebook.
You have a voice made for radio. You should be doing the narration on your own book. You're very infectious.
No, I did, at the time it would consume. I do a lot of podcasts. I do a lot of other things too. But no, I just think a lot of people like audiobook, and so it's coming out there. Yeah.
Well, I like audiobooks because reading takes forever, and I'm in my car a lot, so I enjoy listening to audiobooks. Okay, so you say that's the only thing that you sell on your website, but then you said you're making a lot of money with your company. Well, I mean, are you selling millions of books a year, or how are you making all this money with your company?
I'm making no money on the books. Okay, no, my goal is to not lose money on the book. That's my goal, not lose money. No, I have that. Remember, I mentioned about that insurance type of company where it was a B2B insurance thing.
Oh yes, right.
Yeah. Well, my son's joined me now, and that's going gangbusters. It's really going well for me, and so that's where I make my money. This is where I help people. It's two different worlds.
Oh,
Okay.
interesting, interesting. So you're
Yeah.
still in the insurance game, and your
Yeah.
son is working with you, which is awesome.
Yeah.
So
And I,
okay,
and,
well,
and I love it because you know why? If you ever heard the thing, FIRE movement, financial independence, retire early, it's kind of
yes, yes. There's
popular.
a
Okay.
whole thing on Reddit about that.
Okay, good, good. Okay. Well, I don't like that idea. I mean, it's good to be financially independent, but I don't want to retire early. Mine is Figna in the book, financial independence, graduate to the next adventure. Okay, and that's what I love doing. I mean, when I was 63, I graduated to adventure. I didn't really have the option, and it was great. It worked out wonderful for me. When I was 72, which is what I am now, I came out with this book. It's another adventure. You're going to have me back, Seb, when I'm 82, so you can see my next adventure. We can talk about that on your show. But I just can't believe, I'm not saying retirement's bad. It's good for people who like that. We live on a beautiful golf course. I look at those golfers and I go, I hope you're having fun out there, but I just can't do that. I love visiting with my clients. I love sharing things on podcasts and sharing the books with people. And I just can't see retiring. So I want to keep graduating to the next adventure. And I just like that for my.
Right. Well, now I have to ask, Gil, you're 72 and you look great. What's your secret? I mean, like you seem like you have a lot of energy. I mean, like a lot. So how do you? A lot of people at 72, they report feeling like worn out and tired, and
Oh, yeah.
all this, right? And but you look like you're just like on fire. So what's the secret? I mean, is it your
Well,
workout regimen? Is it your diet, exercise? What keeps you
yeah,
going?
that's a lot of it. But let me tell you, I actually have a one-page health compass, which I don't market or I don't share with anybody. It's private for me. But let me tell you why. Because it answer your question. When I was in my 50s, just a young kid when I was in my 50s, I went to the doctors and got a checkup, and they took a blood test, and they says, David, oh my gosh, your cholesterol is 235. You need to go on statins right now. We got to put you on them. You could have a stroke and die. And I thought, okay, well, let me do a little research for you. No, you don't do research. The doctor told me this story about his father, who he was high cholesterol and he died, and he was almost in tears telling me the story and how he could have saved them if they had statins back then or whatever. I said, okay, I appreciate your story, but I have to do my own research. And he was not happy, but I left the office. I dug into books like I do, this is my 50s before this, and I started studying. And I found out, Seb, that diet and exercise lifestyle has a big impact on our body and our health and that kind of thing. So I did a 180-degree turnaround in how I lived and how I ate. I came back after that turnaround 90 days later, got another blood test. My cholesterol went from 235 to 175. Anything under 200 is really good. I told the doctor because I was so excited. I go, let me tell you how I did. He goes, I don't want to know how you did it. It was just a stupid fad. You got to go on statins right now. This is stupid. You're doing this. I was shocked that his reaction. I mean, I solved the problem and he's acting like I did a criminal thing. He said, well, fad, I am now 72. You know what my cholesterol is now? It's not 175 anymore. It's 165. So it's even better. So some fad that was, okay? I don't know if the doctor, I don't believe he was a crook. I believe he was educated by the medical profession saying there's two ways to solve problems, drugs and a scalpel. There's no other way. Well, that's not right. There's a lot of other ways out there. And I found him. And so it's blessed my life tremendously. And so that's why I think we have to be our own CEOs of our health and our own CEOs of our money. Because if we give that to somebody else, that's life-threatening to me in so many ways.
Yeah, so I'm all about diet and exercise. I mean, I'm not a guru in either one of those, but I certainly believe that you are what you eat, and that
Yeah.
your health has a lot to do with what you put in your mouth. So what did you do to lower your cholesterol? Did you quit eating meat and eggs and cheese, or what's the route?
But
Because my cholesterol is high. I had this other guy on the show a few episodes back, and he was like, "Take this blood test, blah blah blah," and then like we'll give you this customized vitamin regimen, which I'm taking right now.
okay.
And my cholesterol was high. I was kind of surprised because I don't eat that much meat
Yeah.
or anything like that. But so how did you get your
It was
cholesterol down?
basically, I didn't think we were going to talk about this, but I'll tell you, I went on a more of a plant-based diet. I'm not saying I'm an
Plant-based.
extreme, I'm not like a wacko nutcase about that, but I eat much more fruits and vegetables, much more whole grains, that kind of thing. And that really did it. I mean, my weight is, it's great, and my cholesterol is great. I like that because I don't have to manage it. It's got another set it and forget it approach like my finances. It's simple. I do it, and everything works out fine with me. And I don't have to think about my health anymore. I can think about other things. So that's how I do it. So it's the same compass approach, just a different topic.
Right. Yeah. So I right now am doing this. I guess you'd call it a cleanse. I mean, it's I read this book called How to Grow a Whole New Body. By Dr. Alberto Villoldo, and
Okay.
his whole thing is like you're gonna grow a whole new body anyway. Like every few years,
Yeah.
every single cell in
Yeah.
your body is replaced,
I've
and
heard that.
so and so your health will you can rebuild your body by eating, like in a healthy way. And so he and then I had this other doctor on, which an episode's not been published yet, about he's a functional medicine doctor, and he says that the root of all disease, Alzheimer's, cancer, in his opinion, is inflammation, right? Which is all
Yeah,
caused by
that's so true.
to a large degree by eating meat and dairy. So are you like a vegan now? Essentially, is that it? Or
I don't like to use that word, but yeah, I guess I'd like to say I'm plant-based. Okay, but yeah, I guess I'm a vegan. Vegan just sounds kind of weird to me, but no, I am.
are you a
And you're
pescatarian
right.
like Steve Jobs? Do you eat like sushi?
I don't really. I eat veggie sushis. Okay, I do have sushi, but not veggie sushi. They make that now. But no, about the inflammation, he is right. I mean, my inflammation. I should have arthritis at my age. It's like I nothing like that. I don't. I have nothing like that. I'm not on a simple prescription drug. I don't take any pills. I mean, my medicine cabinet is like has a few vitamins. That's it. I mean, there's no those pills. And I just believe that there are ways, if you can eat right and exercise right, that you don't need all that stuff. In the medical profession, they don't get it. A lot of them, they really don't get it.
Well, they don't, because they want repeat customers, obviously,
Yeah,
right? I mean, like they want you to be to sick to like a low level illness, like diabetes is a perfect illness, right? Because like
yeah,
that just goes on forever. It's
yeah,
supposedly incurable, right? So they just want
yeah.
to keep
Exactly.
you. They just want to keep you there.
Yeah,
So
can I say this? I'm from a small town in Ohio, very small town. You know the biggest industry in our town? The hospital and the medical. And everyone's getting sick. And they had a big, huge wing. This is a small town. They had a huge wing put on. It's like, what the heck? Everyone's going there. Everyone's there. It's just like, it's crazy. I want to go in there and just yell at everybody, hey, please, we don't need this. There's a better way to do this, but I can't do that.
right, exactly. Go back to eating the foods that your body evolved on, and
Yeah,
probably you'll be in much better shape. And I know that this is off topic from what like
that's
your
okay.
locus of your interest, but I just think you're like a poster child for like aging well, right? To be honest, I mean, like to my mind, from my vantage point here, you're crushing it, man. You're crushing it, and I think a lot of people want to know, like, hey, how does that David guy? How does he like have this much energy at 72 and then still so sharp and still so engaged? So kudos to you, and thank you for
Thank you.
sharing that with us. And then I want to close this question here. Your Figna that you mentioned. So what do you think is next for you? What's your next adventure after this?
Well, I just started the book, so I mean, it just came out in January, so this is still the early
Oh,
part
it's
of
a
my.
brand new book. Oh, I didn't
Yeah,
realize
it's a
so
brand new.
new.
Yeah. So it just came out. So this is going to be it for a while, okay? But I don't really know. I love volunteer work. We have a place called St. Mary's Food Kitchen. It's one of the biggest in the country, and I love to volunteer there every month. It just feels so good. And I go with my brother. It's something we do together, that kind of thing. And I love sharing this with people. And I really love my company. I mean, it's fun to do it. It's like me playing. When I get to visit with my clients, it's like and go with my son, and it's just like. It doesn't get much better than that. I can't see sitting in front of a TV for 8 hours. They say a lot of people, when you retire, that's kind of a big part of it, what it is. I die. I would die. I really would die. I know it.
Do you even own a Barco Lounger?
What is that?
It's one of those like a lazy boy or whatever, right? I mean,
I do. I do like to, when I'm having breakfast in the morning, I do like to turn on the financial news. I don't listen to it. I would never take their advice on anything, but I find them entertaining. I find it. And then right before I go to bed, I like to watch a little bit of TV, just a little bit, because it just kind of winds me down for the day. But that's it. There's no like sitting in front of the TV during the day and that kind of thing. I just can't do it.
right. So you don't listen to that guy. What's his name? The guy who shouts at everybody. I forget his name.
Oh yeah, I know. Yeah, I know you.
MSNBC or whatever.
Yeah. I know you're talking about. Yeah. No, I don't. Kramer is Kramer's like
Yeah,
that.
right. That's it.
Yeah. No, I don't listen to him at all. I would never listen.
Right.
I'm not against those people. They have to make a living too. But let me tell you how they make their living. They make their living by ratings. And so if they get you excited, like the market's crashing, we gotta get. Then you're tuned in. Oh, I gotta watch him. I gotta follow him. That's all just a show. You don't need all that. Once you understand, like I finally figured out with my compass, all of it's noise. It's just noise you do not need. I promise you.
Right. And I'm guessing that you're not a subscriber to the Motley Fool either.
No, I'm not. I'm not against these people. They all have to make livings and that kind of thing, but it's not me. It's not my thing.
Right, not your bag. All right, David, this has been a fantastic episode of 60 Plus Uncensored, if I do say so myself, and I owe it all to you. You have been a tremendous guest. I'm very happy that you were able to spend some time with us today. Before we go, is there anything that I should have asked you that I didn't ask you that you want to make sure people know about?
No, I just would encourage everyone to go to onepagewealthcompass.com/free. Get your free download of your One Page Compass. It'll simplify things for you. It'll clarify things for you, and you don't need all the complicated stuff. Onepagewealthcompass.com/free, and that's what I would recommend everyone do.
All right, very good. David, thank you so much, and I will catch you on the flip side.
Thank you, Seb.
All right, that's a wrap for this episode of 60 Plus Uncensored. Huge thanks to David Nassif for setting the tone with such honesty and insight. Now, if you like this episode, and I know I did, do me a favor. Hey, do David a favor. Hit that subscribe button, leave a review, and share it with someone you know who needs to hear it, and you know someone who needs to hear it. Oh, and by the way, if you know anyone else over 60 who's still out there doing big things, living boldly, working with purpose, or aging on their own terms like David is, I would love to hear from you. Reach out at team60plus.com or join the conversation at 60 Plus Living on Facebook. I'm Seb Fry, and this is 60 Plus Uncensored, because as we're learning, life after 60 isn't the end, it's just getting good.
Subscribe now